Debt. For some, it's a burden, a chain that ties them down. But for the wealthy, debt isn't a setback, it's a launch pad. Today, we're diving into the secret world of how rich people use debt to create empires and how you can leverage these strategies to grow your wealth. Debt doesn't have to be a four-letter word. When used correctly, it becomes a tool for creating opportunities and building wealth. Let's unpack how the rich master debt and turn it into their advantage. Our journey begins in the 1800s with a name synonymous with wealth, John D. Rockefeller. He didn't just build Standard Oil through savings. He built it with strategic borrowing. Rockefeller leveraged loans to buy out competitors, creating a monopoly that cemented his legacy. By taking calculated risks with debt, Rockefeller used loans not as liabilities, but as stepping stones to control the market. He ensured that every dollar borrowed had a clear path to multiplying itself, turning competitors into allies and small opportunities into massive gains. Debt was not just a necessity, it was his strategy for domination. Fast forward to today, and the principles Rockefeller used still echo in how the wealthy operate. Real estate is one of the most common and lucrative ways to turn debt into dollars. Imagine you find a property worth $500,000. It's in rough shape but holds potential. You secure a mortgage with a 20% down payment, investing an additional $50,000 into renovations. After the work is done, the property's value rises to $800,000. You refinance it at the new value, pay off the original mortgage, cover your renovation costs, and pocket the difference. What started as debt becomes profit, and you now have an asset generating rental income and building equity. This cycle is repeatable, scalable, and a cornerstone of wealth building for the affluent. But the rich don't stop at real estate. Tech magnates like Elon Musk have taken debt to a whole new level. Musk doesn't sell his Tesla shares to fund his lifestyle. Instead, he borrows against them. This strategy keeps his assets intact while avoiding the tax burden of selling. Loans against stocks are tax-free, providing liquid cash to use for personal expenses or new ventures. Musk's approach is a masterclass in leveraging assets for maximum growth. By keeping his stocks, he also signals confidence in Tesla's future, boosting investor trust and, in turn, the company's stock value. Even at the foundation of businesses, debt plays a critical role. Consider global trade. Thousands of factories in countries like China are willing to supply products on credit. Imagine you want to start a business selling pens. Instead of paying upfront for inventory, you secure products on credit from a trusted factory, sell them, and repay the supplier once profits roll in. This cycle has fueled global commerce for decades. By using credit effectively, businesses can scale operations without the need for large upfront investments. Debt isn't just about expansion, it's also about timing the market. Short selling is one way the wealthy use debt to profit in falling markets. It works like this. You borrow a stock from a broker and sell it immediately, pocketing the current value. Later, if the stock price drops, you buy it back at the lower price, return it to the broker, and keep the difference. While risky, this strategy allows savvy investors to profit from downturns. Hedge funds often employ teams of analysts to predict such movements, turning market dips into profit opportunities. Credit scores are another secret weapon of the wealthy. A strong credit score opens doors to loans with lower interest rates, reducing the cost of borrowing. The rich meticulously build and maintain their credit profiles, ensuring they can borrow at favorable terms whenever opportunities arise. For them, borrowing isn't a last resort, it's a strategic move. High credit scores are proof of reliability, making lenders eager to offer attractive deals. Let's circle back to real estate for a moment. For the rich, buying properties isn't just about having a place to live. It's about generating cash flow and tax benefits. Rental properties bring in monthly income that often exceeds the costs of mortgages and maintenance. At the same time, depreciation allows property owners to claim tax deductions even as the property's market value appreciates. This combination of cash flow, equity growth, and tax savings makes real estate a favorite among the wealthy. The strategy doesn't end with physical properties. Real estate investment trusts, or REITs, allow investors to pool resources and own shares in income-generating real estate without the responsibility of managing properties directly. REITs use leverage to enhance returns, mirroring the strategies employed by individual real estate moguls. Now, let's consider the leveraged buyout, or LBO, a favorite tactic among high net worth individuals. An LBO is a bold move. You use debt to acquire a company, securing the loan against the target company's assets and cash flow. This approach allows investors to control a company with minimal upfront investment, amplifying returns as the company grows. It's not just about owning a business, it's about owning the right business with enough revenue to service the debt and generate profit. Liquidity is another hallmark of the wealthy. Rather than selling assets to fund investments or expenses, they take loans secured by those assets. For example, an art collector might take a loan using their paintings as collateral, keeping their collection intact while gaining the cash needed for a new venture. This strategy ensures their wealth continues to grow while maintaining the flexibility to seize opportunities. Inflation also plays a role in how the rich view debt. Over time, inflation erodes the real value of money, making long-term, low-interest loans more appealing. Imagine taking out a $100,000 loan today. In 20 years, inflation may make that $100,000 feel like significantly less, effectively reducing the cost of borrowing. Meanwhile, the assets purchased with that loan, such as property or stocks, are likely to appreciate, creating a double win. The key to using debt effectively lies in understanding the difference between good debt and bad debt. Good debt is an investment, like a mortgage for a rental property or a loan to expand a profitable business. Bad debt, on the other hand, drains resources without generating returns, such as high-interest credit card balances for discretionary purchases. The wealthy avoid bad debt like the plague, focusing instead on debt that builds wealth. One transformative concept is the 30% rule. This guideline suggests that no more than 30% of your monthly income should go toward debt repayments. This balance allows room for savings, investments, and unexpected expenses. Sticking to this rule ensures that debt remains a tool for growth rather than a source of stress. For example, an entrepreneur might use the 30% rule to determine how much debt they can responsibly take on to fund a new venture. By staying within this limit, they maintain financial stability while pursuing growth opportunities. This disciplined approach is a cornerstone of wealth-building strategies. Opportunity cost is another critical factor. The wealthy constantly evaluate the trade-offs of their financial decisions. Instead of paying off a mortgage early, they might invest the extra cash into higher-yield opportunities. It's about ensuring every dollar works as hard as possible. Finally, tax optimization is a game-changer. Interest on certain loans, like mortgages or business loans, can be deducted from taxable income, reducing overall tax liability. The wealthy are experts at navigating tax laws to ensure they pay no more than necessary. By using debt strategically, they align their borrowing with tax-saving opportunities, further enhancing their financial position. Debt isn't inherently good or bad. It's a tool, one that, when used wisely, can transform your financial future. The wealthy don't fear debt. They master it. They use it to create opportunities, scale their ventures, and secure their legacy. Whether you're an aspiring entrepreneur, a savvy investor, or someone looking to grow their savings, the strategies of the wealthy offer valuable lessons. The path to financial success isn't about avoiding debt altogether. It's about understanding its potential and wielding it with precision. So, the next time you think about debt, remember, it's not about what you owe, it's about what you grow. The only debt you have to be afraid of is that of not having subscribed to this channel yet. This may not change your life. See you soon.